they lost about $8 billion. Okay. Now, a healthy bank typically has a capital ratio of 10 to 12%, a very healthy bank. And 8% capital ratio is how much of your assets are financed by your own money or so-called subordinated loans, the so-called tier 3 capital, long-term loans that are paid after the depositors are paid, uh, your own money or tier 3 capital in general as a percent of your assets. That's 4% of your assets. Okay. Again, a healthy bank starts around 10, 12. You suddenly went down to below 8. If you're around 6%, that's almost automatic trigger for your regulator to take you in. And the bank run was not even completed yet. This was only half of it. Why do you think these guys went down? Basically, uh, their deposits were not diversified, so they had to keep a lot of liquid assets. But yes, treasury bonds are liquid. Selling $50 billion worth of treasury bonds would not take you more than a minute in the market without actually affecting the market that much. But the way they took the risk that interest rates were going to go up. In and of itself, that's not a problem. Banks are in the business of having short-term liabilities and having longer-term assets. That in and of itself is not a problem. But if you have to use those longer-term assets as your liquid assets in order to cover a possible bank run, then you're in trouble. What they should have done, they should have managed the risk, interest rate risk. They almost had no interest rate risk management. That was the problem. So let's see how we could have done something about this. First, I'm going to do something relatively hypothetical. Their portfolio had financial duration of 17 and a half. Suppose they borrowed or they financed this loan with a 30-year loan with no, let's not go into that. They need to do something that would give them profits if interest rates went up. Okay. There are many instruments, but I'm going to show the simplest one is to use Euro dollar futures. These are financial contracts that pay you money if 3-month interest rates go up. You make or lose money if 3-month interest rates go up or down for short and long positions. I'm going to get more into what those mean, but let's kind of figure out what we need to do. If we go to CME Euro dollar contract, not ME, CME. Okay, yeah. What the hell happened? You don't have it anymore? They may have changed it. Maybe they changed the name. Okay, let's look at the specs. Anyway, I have only about 5 minutes left. We'll continue next time. I'll find the contract. But the idea is you're going to take a position because if you have $50 billion worth of bonds that you want to hedge, if interest rates go up by 1 basis points, you're going to lose 0.158, multiply that by 50 billion. You're going to take a position such that if interest rates actually went up by 1 basis points, you're going to make that kind of money. All right. But on Monday, we'll continue with Euro dollar futures, write our own function for what you want to call financial duration. and apply that to manage that risk. I'll see you guys Monday. Again, from now on, we'll meet in this room.